Welcome, everyone. I hope you don't mind. We have a co host here. This is Marley. He's my editing buddy. Marley, say something. Oh, thank you, buddy. Thank you. He doesn't say much. This is like the quietest dog on planet Earth. But thought you would meet him. This is Marley. Say hi, Marley. Thank you. Okay, that one's in the mouth. All right, go. All right. Welcome back, everybody. I appreciate you all being here. This is going to be a Patreon exclusive. We're going to be talking about valuation. That's the big subject of today. Is we had part one, and I hope you enjoyed that exclusive. I got a lot of good feedback where we went over different types of valuation. We went over PE ratios. We went over price to sales and enterprise value to EBITDA and even the free cash flow yield. And we even looked at discounted cash flows a little bit. So if you haven't seen it, check out that one in the exclusives. Just go to the exclusives channel on Discord, scroll up a little bit, and you'll see valuation part one. Again, this is part two. Now, before we even jump into that, I have to do a couple quick announcements while all of you are listening. The scammers, they are relentless. These people work so hard, and I wish they'd just get a real job and do something productive. But unfortunately, they always exist. Scammers follow me on YouTube and they message people in the comment section. They follow me on Twitter. They make fake accounts and message people. They follow me on Instagram and they impersonate me on Instagram with accounts that replicate my entire Instagram page with all of my photos, all my videos, everything. They repost all of it and they even have followers somehow. I mean, they really go to great lengths to try to scam my audience. And I don't like that one bit. But they've also followed us to Discord. And there's unfortunately, it's all the same. The scam is always the same. So here it is. You get a message and it's from a Joseph Carlson and it has the same name and the same profile image. Everything looks kind of the same. But then they start telling you about, they might ask you how you're doing. And then they start telling you about some website or something they're working on that you haven't heard of before. So let me just make this clear. I don't randomly message people on the Discord. I don't have to friend request you because you're already on the same server as me. And I never message random people and tell them about exclusive secret things that I'm working on that I haven't shared publicly. I'm extremely transparent. Everything that I share that we're working on, I share it openly to all of you at once. I don't share secret things. So if you get a message from someone on Discord and you're a little bit wary about it, it's probably not me. I would be very open. I'd just message you right in the chat, right in general chat. I'll just tag your name and say, hey, I need to message you or something. So just keep that in mind. They're on Discord as well. They've been making the rounds. I found one that joined the Patreon and made an account and then switched their name to Joseph Carlson and did that. They're banned. So they got blocked on both the Discord and the Patreon, but they're not going to be the last. So just a heads up on that. If it seems suspicious or whatever, it's not me. Everything that I'm doing is completely transparent. I'm working on Qualtrim. We're working on the same stuff. So having said that, let's go ahead and talk about valuation here. Let me open this up a little bit. The computer will lag a second while I open this up. Last time we left off with discounted cash flow, and it's always exciting, discounted cash flow. It excites investors, and I like that because it's kind of like, you're trying to bring structure to valuation. And that's mostly what investors are trying to do. I think a lot of times the spreadsheets and the discounted cash flow analysis is just a simple way of saying, I have all these thoughts about different companies, but I'm not quite sure about what they're worth, and I want to have it down on paper. I want something more structured. And that's where DCF and spreadsheets comes into play. You put your thoughts on paper, makes it feel a little bit more secure and more structured. And I think that's a good thing. I think putting your thoughts down on paper and actual numbers is a good thing. But what I'll say is there's also a downside to this. And that's what I want to go over in this episode. And I want to focus on what this doesn't say. And I think it's the single biggest part of where we have a chance for outperformance. I think the biggest problem with putting down assumptions like this on spreadsheets, or even just doing it in our head, but either way, the biggest problem with valuation and the biggest thing that people miss is one word. It's risk. That's it. risk. That is the biggest issue. Now, in terms of discounted cash flow, you have something to actually calculate risk and try to you try to factor in risk. That is the discount rate. So basically, the higher risk the asset you're investing in, the less predictable, the more chance you have of it going bankrupt or losing money, you bump up the discount rate. So I could put this at 12%, right? If I think that Texas Roadhouse is very risky, then I have to have a higher margin of safety and price to buy this to compensate for the extra risk, right? But again, this is, I think, a very incomplete calculation of risk. And I don't think applying a discount rate is the way that we should view risk when investing. Risk, I believe, is the most important single topic for investors to think about. It's the thing that Warren Buffett talks about the most. We have Howard Marks has written multiple books just on risk. And he says openly that when you're an investor, what you're trying to do is understand risk and control risk. There's a lot of misconceptions about risk. There's people that think that higher risk equates to higher reward. And Howard Marks points out, if that were true, if higher risk was a guarantee of higher reward, then it wouldn't be risk. You wouldn't be taking risk because you're getting a higher reward, right? So that's not really true. Higher risk doesn't lead to higher reward. So a lot of misconceptions about risk. And rather than going into a big, deep discussion about risk, I just want to go over pretty briefly how I view risk and how I think why I think it's the number one way that we have a chance for outperformance. I think that we have a chance to outperform with the companies that we have, with the investments we make. And I think it all comes down to not taking on more risk. I think it comes down to taking on less risk, to having similar returns as other people with less risk. So let's go ahead and I'll open up Qualtrim here. And we were just given, I think, the best example of this. So if you're looking at a discounted cash flow analysis, let's just pretend for a minute, we're looking at Texas Roadhouse here, but let's just pretend for a minute that we're looking at Intel's. Intel's discounted cash flow analysis by the numbers a year ago looked very attractive. If you are just a mathematical person and you wanted to write down your thesis on Intel, you look at the numbers, you look at the free cash flow yield, you look at the operating income, you make your projections, you go, wow, this thing's undervalued. Intel's a great company at a reasonable buy, and I have it down on paper. So I'm feeling pretty good about this. I have my Intel DCF spreadsheet. It shows the company's a cheap company for the cash flows that I'm getting. And you have the big, long cash flows in the future. What are you missing from this calculation? What is the spreadsheet not accurately factoring in? That pesky thing again. Risk. That's the thing that it's missing. Investors a year ago they weren't accurately factoring in the risks that come along with Intel's business, because you can't factor in the risks that come along with Intel's business without understanding their business model. Putting a discount rate on it does not really factor in the risk coming along with Intel's business. So again, when you're doing valuation, if you're valuing a company, part of the valuation is looking at risk factors and factoring that in. So let's go over some of the risk factors here. And let me open up another spreadsheet here. All right, so let's go ahead and take a look at Intel. And I just want to highlight the risks that investors were taking with Intel that they probably didn't factor into their DCS because it doesn't fit in to these type of calculations. So let's bring up Intel here. Okay, so we have Intel brought up on Qualtrim. The company, I mean, it looks pretty cheap, 15 PE, right? It's a cheap company. The free cash flow is all wacky now because the company's not making any money, but a year ago, the company had a very attractive free cash flow yield. So on paper, again, I want to make the point here. On a normal DCF, this looked attractive a year ago. But when you factored in the risk, even a year ago, I was thinking this company doesn't look attractive to me. I don't think it's good value. So we go back to Qualtrim here. And here's a couple things that I think are actual risk that needs to be factored in. The first thing we can do is we can look at it annually. I can look at the revenue of the company. In 2021, it revenued $80 billion. So we're not working with hindsight, or we're not working with 2022's data. We're working with 2021's. It did $79 billion in revenues. So we can just round that to 80. Let's go ahead and look at how much CapEx this company had in 2021. This company had $20.3 billion in CapEx requirements in 2021. So the simple math here, they did $80 billion in revenue and they did $20 billion in CapEx. 20, 40, 60, 80. So 25% of their total revenue went to CapEx in a single year. 25%. To put that in perspective, on the high end is like Union Pacific, which is 15%. 25%, a quarter, 1/4 of your revenue going to CapEx means that this isn't a capital intensive business. This is a monstrously capital intensive business. Monstrously capital intensive. Capital intensive businesses have an added layer of risk that capital light businesses do not have. An added layer of risk. So if you consider this, if you're running a business and you're running one that's very capital intensive, you get $100 in revenue and you instantly have to take 25 of those dollars and make investments today in things that will hopefully pay off in 4 years, 5 years. That's the CapEx requirement. So you're taking money in, a quarter of it right there gets chunked away, gets invested, and hopefully you make money back on that later. What is the other risk with heavy amounts of CapEx? The expected returns on that CapEx. You're making the investments today. What is the return going to be? You don't know. You have to wait and find out. Is there risk to the return being low or high? Of course there is. What if Intel spends this $20 billion and they develop a chip that's actually behind what Apple developed? What if they spend this $20 billion and they work at a warehouse and it goes through some development problems? There's risk to the CapEx. You don't even know what the return is going to be. So you have a quarter of your revenue, not your income, your revenue going into this company, and you're just waiting to see what happens. Contrast this with a company that just recently reported earnings and didn't have the catastrophic result of Intel. We can take Visa, for example. Visa just reported earnings and the stock is up today. It's doing well. The earnings were right down the middle. Very reliable earnings. Visa's doing fine. We look over the past year, Visa's down 2%. What is Intel down? I think over the past year, it's down like 30% or something like that, maybe a little bit more. Yeah, it's down 41%. So Visa, even though the company on paper is more expensive. So valuation wise, I'm buying a more expensive company when I buy Visa. Because on paper, Visa is a 25 forward PE ratio when Intel was a 15, right? So a lot of people, they would argue with me and say, Joseph, you don't pay attention to valuation. I'm a true value investor. I'm buying Intel at a 15 PE ratio and you're overpaying for Visa, right? At a 25 PE ratio. Okay, that's factoring in valuation without factoring in the most key part of valuation, which is risk, the actual appropriate discount rate. So if you actually factor in the risks, we can just highlight a key difference in risks between Visa and Intel. Again, we go to the revenue of Visa, and we can use 2022's numbers here, but it's basically the same proportion every year. Visa did $29 billion, $300 million in revenue. So we can just round that up to $30 billion in revenue. And they did in CapEx just under $1 billion in CapEx. So just under $30 billion in revenue, just under $1 billion in CapEx. Now, you look at that, and that means that they spent 1/30 of their revenue on CapEx. Again, we're putting this in proportion. Intel spent 1/4 of its revenue on these big investments it has to make every single year. Visa spent 1/30 of its revenue on investments. So Visa spent 3%. Intel spent 25%. Visa gets money all the time from customers. Just daily, they're getting money right away. They get to keep 97% of it for themselves. And then the other 3% goes to CapEx requirements, whatever those might be, right? A couple servers to run their processing or something. As opposed to Intel, which gets $100 and $25 is chopped right off the top to go to CapEx. Does Visa have to worry about ROI on their CapEx requirements? Does it really matter if that 3% gets a high return? Intel, that's a huge concern, the ROI on their CapEx, because that's a quarter of the revenue. Visa, it's 3%. So the ROI on it doesn't really matter. They don't have to get a good return on it because it's such a minimal part. It's barely even part of the revenue. That's one risk. That's something, again, it's not going to be represented in terms of risk on this spreadsheet. It'll be in terms of an expense. So you have the CapEx here, but it won't be in terms of risk. And I want you to look at this in terms of risk. Let's go ahead and just highlight another risk that's different between a company like Intel and a company like Visa. Okay, so we have Intel here. We can look at the company again. Just a reminder, they did what was it? $80 billion in revenue. Okay, so they have a lot of revenue. Let's go ahead and look at another metric here. We can cross out the research and development. So think about this for a minute. The research and development basically goes up every single year. It goes up a little bit different, some years more than others. But if you consider the fact that Intel's in a market where, is Intel a duopoly? Do they basically have a stranglehold on the market? Are they like Moody's and S&P? Are they like Visa and MasterCard? Not really. You look at the market that Intel competes in. Who are their competitors? Well, they have, I'm not super familiar with the industry, but I know there's a lot of chip makers and silicon makers. Apple just made their own silicon. From what I hear, it's very good. Apple puts the benchmarks up that they're basically crushing Intel at what they do as their own game. So Apple just booted Intel and said, we're no longer working with you. AMD is a competitor. NVIDIA is a competitor. I think you have like TSM. You have Amazon making their own chips and things, their own silicon for their servers. You have Alibaba making their own stuff. So a lot of companies are making it in-house, vertically integrated, designing it in-house. Intel has to compete with basically companies doing it for themselves, as well as a lot of well-capitalized competitors, all trying to do the same thing. And the industry in and of itself is rapidly changing. You consider what's really changed with Visa and MasterCard in their business over the past 10 years. Have they had to rapidly develop a new type of payment processing system that's 1,000 times faster? It's not the same with chip makers. This is an industry that changes very quickly. So those R&D costs are steep and they increase all the time. And this is to stay competitive with your many intense competitors that you compete with. They did $80 billion in revenue and $15 billion went to R&D last year. $15 billion. So what is that, like 10, 11% goes to R&D? So now you have 25% of the money that the company brings in goes instantly to CapEx, and that's based off 2021. And then another 10 to 11% goes to R&D. So you're down to 35% just being gone right off the bat. R&D has risk. There's risk in this. It's not just a magical thing where they put $15 billion into research and development and they know for sure that they're going to have something better than the competition a year from now. It's unknown. It's a little bit risky. Now, they might if they have the best talent, if they have the best people, but maybe AMD hired all of them. Maybe they took the best cooks in the kitchen and said, hey, engineers, you want to get paid a little bit more? Come over to AMD. So AMD has more effective R&D. We don't know. We're just guessing as shareholders. But what we do know is that this brings on additional risk. We compare this with Visa. We look at Visa's, again, reminded of their total revenue, $30 billion. And then we look at Visa's R&D, and it's not really even, it's not a data point. It doesn't even exist. If I look up on Google, let's see if Qualtrimm's just missing it here. Visa total R&D cost. Let's see if I'm missing something on it. It was $0 billion in 2022. So Qualtrimm isn't incorrect here. It just has nothing to show. Like there's just, it's probably like $1 million or something, and it doesn't even show up on the chart. Okay. Mathematically, you would just look at this as them saving $15 billion. But again, that's only part of the equation. I also look at this as Visa just has less risk. They don't have to put 11% of their revenue into R&D in hopes that they might have a better product at the end of 2 years. I mean, you go on with this. The expenses and the risk associated with the expenses of a capital intensive, highly intensive R&D business or a highly intensive sales and marketing business are much greater than a business that is capital light, that has organic growth, that doesn't have intense competition. I look at a company like Visa and I observe the competitive threats it faces. And you basically have MasterCard and Amex, which they work in tandem. They both raise prices at the same time. They both charge about the same. They're basically just two legs of the same body. I mean, they're the same companies. They're a duopoly. You look at Visa's other competitors, and I don't really consider crypto a credible threat anymore. I look at PayPal, and they work with Visa. I look at Apple Pay, and they work with Visa and MasterCard. Most companies have decided it's just easier to go through Visa than try to go around them at their own detriment. So Visa has very limited competition. They're a duopoly. Intel has intense competition, all gunning for market share at what it's doing. And these companies pour in tens of billions of dollars because they know they can steal market share. Then what did we see happen? Let's take a look at the earnings report here. CNBC, and I read through this whole article this morning, and it is just shocking how bad this report was. It's one of those things where the more you look at it, the worse this looks. It just, when you dive into an earnings report and you're going, I have two different reactions when I dive into an earnings report. I go, either this isn't as bad as the street's reacting is my reaction. And sometimes that's with stocks that I don't own. Sometimes that's with stocks that I do own. Or sometimes I go, wow, this is worse than how the street's reacting. And again, sometimes that's with companies I own or I don't own. This is one where I genuinely don't know why people own this stock. When I was reading through this, it's just so bad. Their revenue is going down substantially below forecast. Their margins are going down. They're losing market share. They might not even be able to pay their dividend. I think there's a good chance by the end of this year, they'll cut the dividend. I really think there's a decent chance of that. The CEO went on to CNBC and tried to explain himself. He's trying to put a happy face on it, but the problems are brutal, as CNBC describes. Why does this company have headlines like this? And you don't really see that with a company like Visa or a company like MasterCard. It's risk. That's what describes it. Intel is in a category of companies that I think has considerably higher risks around the business model, around the competitive industry, around the way that they get money. You can even look at the flows of money. And a company like S&P Global or Visa or MasterCard, they get money right away from customers, right up front. Every single time you swipe a card, instantly they're getting money. They can deploy that back to shareholders right away. The flow of money is so instant. Intel has to wait to finish long contracts. They have to put money up front to try to earn it down the road. They have the opposite flow of money that you want. It makes it so much more difficult to run a business this way. There's so many different risks between different companies. And so if you just look at a spreadsheet, and you just plot out numbers, and you might adjust, the discount rate a little bit for it. You're not looking at the business model, the competitive threats, and you're overall not factoring in risk, I think, to a big enough extent if that's the level of research you're doing. I would first try to focus on the risks a company's facing with its business model, and then once you understand the risks, you understand why a company trades a certain way, then you can apply an appropriate valuation for a company. Because I think that a company like Visa should trade at a higher multiple than a company like Intel by a very large degree. It's a one-of-a-kind company. There's not many like Visa. There's many companies like Intel. You're always going to get companies like Intel that are cheap and they have struggles and they might turn around, right? They're having market share taken. There's a ton of those. There's not many Visas or MasterCards. Now, that's just one. I just highlighted a couple risks of basically reinvestment. I think companies that have high amounts of reinvestment have higher levels of risk. If you have a company that has a high amount of reinvestment, meaning they do tons of research and development, tons of CapEx, you have to have an incredibly high confidence that R&D has incredibly predictably high returns on that R&D. So in some cases, I think that's the case. Like when I look at Amazon and I see the CapEx they're doing for AWS, I think that has predictably high ROI. That's why I own Amazon. Otherwise, I think it's incredibly risky. But I want to go through some other things that I look for in companies that I think will outperform, but specifically the risk factors. So let's go ahead and I'll just highlight the risk factors of a company. Again, I just want to highlight, this doesn't show up anywhere on DCFs. It doesn't show up anywhere on formulas. You can't fine tune or have any type of precision analysis or any type of filter you can toggle that will get these type of risks. So these are something that you just have to ask when you are looking at doing analysis on a company. The first one right here, we just went over. High reinvestment of R&D and CapEx. I think both of those things are not only unattractive of a company. I much prefer a company that's capital light and flexible, has a better cash flow profile. But again, that adds on risk. And a lot of investors don't realize the risk that adds on. Unpredictable CapEx ROI. With a company like Intel, when they do CapEx, I don't know what the ROI is going to be. I think it's kind of a toss-up every year if they're going to do really well or not. With a company like Union Pacific, I think it's reasonably projectable. So unpredictable CapEx ROI is a risk factor. Poor competitive dynamics in the industry. If you're looking at a company and you're zoomed in on all the nitty-gritty, sometimes it's good to just zoom out and ask yourself, am I fishing in the right pond? Warren Buffett always talks about fishing in the right pond. You have good industries and you have historically really bad industries. And people fish for companies in each of these pools, right? If I'm going to go fishing for salmon, I want to fish in Alaska where the salmon are literally just jumping out of the water. And I just throw my line in and I have like a 10-pound salmon that I'm struggling to bring back to the boat because it's so massive. I don't want to go to a gigantic lake that has 2 anemic fish in it, that are diseased, and I hope that I can toss my line in and get one of those fish. You want to fish in the place where you have a good amount of companies that even if you miss, even if you don't get the best company, the industry overall is good. Even if you don't get the largest fish in the pool, you want to get one that's decent. So fish where there's fish jumping out of the water. In this case, what are the bad pools to fish in? In my opinion, from what I've looked at and a lot of research, I don't like the car market. I don't think it's a good market. That's why I don't own Tesla. A lot of people like Tesla. I do get the investment thesis. So I understand if you own the company and you have a very specific thesis on it. But in general, I just don't like the car market. I don't only not invest in Tesla. I don't invest in Rivian. I don't invest in Ford. I don't invest in GM. I don't invest in Volkswagen. I don't invest in any of them. In my case, I think it's easier to just avoid the whole pond. I don't want to fish there. I feel like I might get it wrong. And with Tesla, I don't understand it. So I fish somewhere else. Other pools that I don't think are great, but I do fish. I have a couple that I have in here. So I'm breaking one of these rules here. I'm taking on more risk, is restaurants. Historically not a good industry. I have one bet in the restaurant category, which is Texas Roadhouse, because I think it's a standout within that industry. But even that, I do notice and I realize and accept that restaurants are not amazing companies. They're not the best quality of companies. They have high fixed costs. They have high rent expenses. They have lots of employees. They have extrinsic factors, economic factors that affect them. With Texas Roadhouse, beef prices has a huge impact on them. So they have commodity impact. All of that brings up different risks for Texas Roadhouse. So even though it's a great company with a lot of good execution, because it's a restaurant and it's in that industry, it has far more risks than other companies in superior industries. You have retail. Retail is an incredibly competitive industry that has traditionally very low margins. The industry dynamics for retail are not great. Now, you can try to pick out the Dollar Generals and the Home Depots, but it's tough. And knowing when they've hit their peak is tough. Peter Lynch, in his book, he says that it was a mistake for him to sell Toys R Us. Because back in the day, he sold it and it kept going up. Now Toys R Us is bankrupt. These companies in retail, they come and go. You look at the amount of companies that have come and gone in retail over the past 10 years, I can name off a dozen of them that have gone bankrupt. And so retail is not a pond that I'd spend all my time fishing in. It's just like, it's so difficult. You're making the game harder instead of easier. Retail companies face a ton of competition, a ton of risk. And then I think another industry that I think is difficult, but I have a couple companies in it, is heavy industrial companies. A lot of times they have a bigger moat, which is the good thing, but everything that we've gone over with Intel is somewhat applicable to all of these companies. They have to put 10, 20, 30% of their revenue into CapEx. That is a very unattractive trait of a company. Many of them have tons of R&D costs. I mean, enormous R&D costs. Boeing, think about the risks this company has. Supply chains, employee problems, R&D costs, CapEx, and then they have the problem if a plane doesn't do well, if it falls out of the sky, right? There's a lot of risks associated with heavy industrial industry as well. So that's another risk factor. And in my case, I just decide when I'm looking at companies now, instead of fishing in the ponds that I was before, trying to find the best restaurant and all of these factors, I still might look at it, but I'm going to be spending more time in ponds that I think are very attractive. Payment processors. You have companies like Visa and MasterCard, Amex. You have any of these companies. I think you look at the competitive dynamic of Moody's and S&P Global. They are two companies, each one of them with 45% market share of the ratings of debt issuance in the world. Combined 90%. Most companies use both of them because access to the debt markets is so important. The debt market is orders of magnitude, in most cases, bigger than the equity markets. So they basically have a toll bridge built on the biggest market in the world where they collect a fee of. And then S&P Global has a franchise, basically income and perpetuity of index investors that buy S&P 500 related indexes. It's almost unbreakable. It's almost a undisruptible moat that they have with very little competition. It's a natural monopoly. So I look at that and I compare it to something like, I compare it to other investments that we see sometimes. I compare it to Wendy's. And I think, does it have the same moat that this one does? Not really. They're different companies in different industries. So poor competitive dynamics is another risk that we're looking at here. In general, lack of predictability. I think this is one that a lot of investors are just, they're so eager to take on things that are unpredictable. Now, I've tried to look at the psychology of this, and I think a lot of it is because a lot of us, we like the stock market as an avenue of gambling, and the type of videos I see different YouTubers make, the type of content I think they make. I think people like rolling the dice. I think they like going to Vegas and betting on black. I think they like playing poker. I think people do like gambling, and they take that to the stock market. If you're investing in a company that's highly unpredictable, that you don't have any clue what the cash flows are, that's in a highly quickly changing, ever-changing industry with many competitors, you're basically gambling. Let's not sugarcoat it. You're basically gambling. If you lack that much predictability, how are you supposed to go to a spreadsheet and plug in any type of analysis of future cash flows with any certainty at all? The truth is you can't. You're fooling yourself if you think you can. And a lot of investors, they just simply don't care to map out cash flows. They don't care to make a discounted cash flow analysis or any real analysis other than the company's cool. I like the company. It's exciting. Other people are buying into it. I want to have some fun and put some money in it as well. That's not what I'm doing. Sorry if that's more boring. It's not as exciting, but I want companies that have predictability in their future cash flows. Another risk factor, the share structure of the company. The ideal company is one where the CEO and executives have ownership of the company. They like to hold their shares, and they like to be invested alongside their fellow investors. And their compensation is tied closely together with the success or failure of the long term of the company. That's ideal. The risk comes in when you buy companies with dual or multi-class share structures where the CEOs and founders have anointed themselves as the kings of the company. And even though they own an overall sliver of the company, they have all the voting rights. They can do whatever they want. They pay themselves enormous compensation packages. They go on to CNBC, they go to Davos, they go to all the meetings. They're worth tons of money and they have total control over the company and they don't have to listen to the peasants that are the shareholders. That brings on risk because they have a lack of accountability. So when I look at different companies, I notice when management behaves a certain way. I just did a video about Mark Benioff and how he sells shares every single day. Every single day he's selling. He seems distracted by personal pursuits, philanthropy, hanging around with popular people. And it seems like Salesforce is just part of his apparatus. Salesforce is just living in part of his life. It's not his main focus. Then I compare that to CEOs like Ed Pitoniak of Vici, who since the IPO has not sold a single share. Neither has any executive. He has been in it with investors since the beginning. He comes and speaks to investors directly, answers their questions, answers their concerns. He might even be on an inferior company. Vici's probably an inferior company to Salesforce, but he's behaving in line with investors. If you have companies have dual class share structures, that layers on additional risk. How you factor that additional risk into your valuations is important, but it shouldn't be ignored. It should be factored in. Does a company do wasteful pet projects? Do they have a wasteful look at how they use their free cash flow? Free cash flow is only really good if it finds its way back to the shareholder, back to my pockets. Many companies, I think especially, this is one that I will pin mostly to tech companies, they've been a little out of control with their perks. You look at the company culture and it's like these people go around and just eat fine dining from great chefs and they have full-time massage therapists. When Google let go of their 3,000 employees, they fired 27 massage therapists. 27. I've worked at companies, startups that had less employees than just their massage therapists. And we made software that ended up making millions of dollars. And these are employee perks. And I'm not saying that jobs should be horrible and you shouldn't have any perks, but it gets to a certain point. Right? It's like, come on, you look at these, you look at what they're doing and they're being a little wasteful, right? I think that these companies need to tighten their belt a little bit because some companies are. I promise you, if you go to MasterCard or you go to Visa, you go to S&P Global, the environment's different. It's more by the book, getting work done, and efficient use of capital. A lot of the tech companies, I think, have grown a different culture that's very different than the rest of a lot more efficient companies. If you go to some companies that don't have as much leeway, like Texas Roadhouse, they don't have the extra discretionary billions of dollars of a search engine to be so wasteful. So they naturally have a corporate attitude that is much more disciplined with their cash flow. So that's another thing you should look for. Wasteful uses of cash, wasteful pet projects. Google has other bets, which so far it's only burnt money. It's just been an incinerator of hundreds of millions of dollars that they could use to have given buybacks or return that to the investors somehow. But all of that's an extra risk. And then another risk that I think is important is the growth of the company. I look at companies and I'm thinking about ones that I own and how they grow. You have companies that have a core product and they grow in the amount of customers and they grow in price of their product. That is organic growth. Gaining customers, and then when you have more customers, you can raise prices as well without losing them to competition. That's very attractive as an investment. Then you have companies that have a risk in how they grow. That is acquisition-based growth. If a company has to continually do acquisition after acquisition, every one of those acquisitions is a little bit risky. You don't know what the ROI is really going to be. This is the reason that I sold Church & Dwight. It really is. I was just looking at the company and I was going, you know what? It has really great fundamentals. But I think, again, the numbers don't plug in one of the risks here, which is all of their growth over the past 10 years has been acquisition-based. And they've done some good acquisitions, but do I have confidence they can continue to do this for the next 10 years? Nail every acquisition? I'm not so sure. That makes it so that there's a lot of risk in terms of who's running the company. And I don't like the risk of knowing that the business model is heavily reliant on just a couple people at the top making deals, especially in an industry where they're making deals for all different consumer products that are very difficult to predict, right? They have like acne products and the water pick and different things. Like who knows how these are going to do? They base them in different things, but it's tough, and it's tough to judge the ROI on them. Plus, they've been secretive about the ROI on them. They've not told us how the water pick has done, if it's getting good returns or poor returns. So you have acquisition after acquisition, and then you can't even assess the management's returns on those acquisitions. And acquisition-based growth is riskier growth than organic growth. So if a company like S&P Global just grows because there's more companies issuing debt every year, that's just organic growth. If they grow by just raising prices because they still have a monopoly, that's organic growth. They're not buying company after company. And if you have a company that's based on acquisition-based growth, that makes it so you kind of have to have like a Warren Buffett running the company. You have to have someone that really focuses on every acquisition and make sure they're not overpaying for it. Otherwise, again, you get a sales force buying Slack for $28 billion and overpaying for it. So acquisition-based growth, inorganic growth in general, is another risk. So that's basically all I wanted to highlight is when you're looking at companies, I know it's easy to just look at the numbers, plug in an Intel, plug in an AMD, plug in whatever you want. But the future is unknown. Investors have routinely overestimate their ability to judge the future accurately. And what we do as humans is we minimize risk. We don't think things are going to happen to us. We hear statistics of a lot of people getting heart disease and cancers and stuff, but we don't think it's going to happen to us. Like people don't think anything negative is going to happen to them and their holdings. And that's not how the equity markets work. If you take on a lot of risk with your holdings, eventually risk's going to show up. It will. It's only a matter of time. Investors that invested in Intel, they thought they were buying a margin of safety by buying a low price. What they didn't realize is all these fundamental business risks, and those risks showed up for the company. So when you're looking at spreadsheets, factor in the risks that are not seen in the spreadsheets. When you're looking at Qualtrim, factor in these risks that are not seen on Qualtrim. And just to revisit them, it's high R&D and CapEx, unpredictable CapEx ROI, poor competitive industry dynamics, dual class share structures, a key man risk with having the CEO have to be a genius or have to be incredibly good to run the company. You want companies that average people can run. Wasteful use of cash flow, pet projects, CEOs that don't seem focused on efficient use of cash flow, and growth-based acquisition or acquisition that's based on or growth-based acquisition or growth that's based on aggressive marketing and spending on marketing. I think that summarizes a lot of risks that I look for. So when you're making analysis, when you're doing analysis on companies, just think of this type of stuff that you can't put into a spreadsheet. I think that'd be helpful. This is part 2. I'll have another part on valuation that I think will be informative as well. So I hope you enjoyed this. That's all for now. See you all on the Discord.